Despite U.S. market closing in on a record high, investor sentiment is unusually depressed. Joining us from Atlanta to talk more about how markets are reacting is Keith Lerner, the chief market strategist at SunTrust Advisory Services. So, Keith, it's interesting because we got this news last night that the president had considered military strikes over in Iran. And while we have heard the president today talk about why he pulled back, you surprised that the market hasn't reacted in a bigger way, given that this could really put the U.S. right on the brink of some kind of war with Iran?
Well, I think this is yet another, another concern on the carousel of concerns that we've seen over the last few years. I think investors are getting more used to these things that come up periodically. And the bigger picture, which you started the program with, is, we're at new all-time highs in the S&P. And a lot of investors in our work are still underinvested or underexposed to the market. So I think that's part of what's buffering the downside, is that we've already seen a huge amount of de-risking by individual investors. Hedge funds are underexposed. So I think net, from a contrarian perspective, that's a positive. And I don't really sense much euphoria with the market making a new all-time high yesterday. And I think actually that's a positive to actually extend this thing a bit longer.
Keith, you talk about this carousel of concerns, Iran being one, the trade concerns with China being another. And then, of course, there's questions around the Fed as well. What do you see as being the biggest weight right now, and what could be a potential catalyst?
Well, I think a big catalyst is some of these things are simmering down a little bit. Even with next week when we have the G20, I don't think we need a trade deal, but just to know there's some progress moving forward, I think is good enough for the market. And the big picture, we're almost moving back to a TINA market as far as there is no alternative. You have the 10-year yield down over 1% over the past year. You have the Fed likely cutting short-term rates. And on a relative opportunity, what does that leave you with? Leaves you with, in our view, stocks that look relatively attractive. And you also have now about 45% of the stocks in the S&P now paying a dividend above the 10-year yield. So I don't think you need a big catalyst. I think you just need things not to get much worse relative to depressed expectations that we're seeing today from investors.
Keith, now in your note, and I know you just mentioned it a moment ago, you say that this investor nervousness is actually a positive and could add fuel to a market rally. I'm wondering if you can explain that thinking just a little bit, and exactly how much fuel do you think it's going to add?
Yeah, it's tough to quantify the exact amount, but let me go through some of the other statistics. So the most surprising thing, as we looked at our work, is over the last 12 months, we've seen the greatest outflow of ETF and mutual funds in at least 20 years. And this is coming right now where the market is at a record high. Normally, you see these type of outflows after a big decline when people panic, and that marks a bottom. So it's a lot different than history. But if you have investors who may start, if you start to see the market move up more, you may start to see some of these folks get back in. And then I mentioned, you think about hedge funds right now. Their exposure looks relatively low as well. And then we just saw a fund manager survey over the last week that just showed cash levels for fund managers just jumped to the highest, had the largest 1 month jump since 2011. And as you get later in the year, there'll be some anxiety around performance and performance chasing in our view.
Hey, Keith. So I know a lot of market watchers are turning their attention to earnings season, which kicks off in about a couple of weeks. Do you think that the current earnings estimates have priced in some sort of tariffs? And if not, what do you expect for earnings season?
Yeah, it's interesting because I think a lot of the analysts are having a difficult time quantifying the extent of the tariffs. I think what we've seen so far, the forward earning estimates have still held in there pretty strong. We suspect they come down some, but again, I'll go back to, say, the equity risk premium, which is simply comparison of equity valuations to fixed income. It's at a very high level, which suggests that a lot of uncertainty is out there already. So I think the market can handle some downward revisions in the earning estimates. However, if for example, the next tranche of tariffs go through, I think that would be a bigger issue for the market.
And Keith, very quickly, on the back of the Fed decision, we saw a big pullback in the dollar. And you've pointed out that, weakness in the dollar could lead for a good investment case in emerging markets. Are there any particular ones that you're looking at right now?
Yeah, the one thing I think, just going back, so we've had a nice reset in the 10-year Treasury. We've had a nice reset in the U.S. dollar. That should be positive for emerging markets. Specifically, we like the basket as a whole. We've also been looking or investing directly in Brazil as an example, and also on a more aggressive side, China, thinking there will be some progress on trade.
Okay, Keith, we'll have to leave it there. Appreciate your time. Keith Trust joining us from SunTrust Advisory, or Keith Lerner, I should say, joining us from SunTrust Advisory Services.
Thanks so much.